Hello, welcome to this presentation on value-added tax. Value-added tax is a tax that are levied on supply of goods and services. VAT output is charged on sales or services rendered. If it is a cash transaction, then the VAT is recorded in the cash receipts journal. For credit transactions, the VAT will be recorded in the sales journal or the sales returns journal. VAT input is paid on purchases or services. The VAT payable with cash transactions is recorded in the cash payments journal, and for credit transactions in the purchases journal or purchases returns journal. This means that VAT output is the VAT any business will owe to SARS, and therefore money will flow out of your business bank account to SARS. VAT output is a current liability. VAT input is the VAT you claimed from SARS, and therefore SARS owes you money. The money will therefore flow into your business from SARS. VAT input is a current asset. There are three categories of supplies, namely taxable supplies, zero-rated supplies, and exempt supplies. All registered VAT vendors must charge tax on taxable supplies at a rate of 15%. Registered vendors may only claim input tax equal to the amount of the VAT they paid to vendors on goods and services acquired in the course of providing taxable supplies. The prescribed tax rate for zero-rated supplies is 0%. This means that no output tax is payable to SARS on these items, but registered VAT vendors are still entitled to claim VAT input on goods and services acquired in the course of providing zero-rated supplies. Services to welfare organizations, the sale of a business as a going concern, fuel, and certain food products are examples of zero-rated items. Exempt supplies are not taxable supplies. Vendors may not charge VAT on exempt supplies and are not allowed to claim input VAT on any goods or services acquired in the course of providing exempt supplies. Interest received, interest charged, residential accommodation, and educational services are examples of exempt supplies. VAT input may not be claimed on the following items, since the VAT Act specifically excludes these items from claims. This includes entertainment expenses, salaries and wages, membership fees in respect of any club of a sporting participating, social or recreational nature, goods and services not utilized for taxable supplies, goods and services purchased from a non-vendor, and passenger vehicles. For accounting purposes, it is important to know how to calculate VAT. If you are given an amount excluding VAT, for example 1,000 Rand, you can calculate the VAT amount by multiplying the 1,000 Rand with 15%. To determine the full amount payable or the amount inclusive of VAT, you add the VAT amount to the amount excluding VAT. Therefore, 1,000 Rand plus 150 Rand equals 1,150 Rand. If you are given an amount inclusive of VAT, for example 1,150 Rand, you could also calculate the VAT amount. It is important to note that the 1,150 Rand includes the VAT amount of 15% and the amount excluding VAT represented by 100% of the original amount. In other words, 100% of the amount excluding VAT plus 15% VAT equals 115% as the amount inclusive of VAT. VAT is therefore calculated by dividing 1,150 Rand by 115 and multiplying the answer with 15. The VAT amount is 150 Rand. The original selling price, exclusive of VAT, can now be calculated by deducting the 150 Rand VAT calculated from the 1,150 Rand that was inclusive of VAT, or dividing 1,150 Rand by 115 and multiplying with 100. The selling price excluding VAT is 1,000 Rand. After watching this presentation, you should now be able to differentiate between input and output VAT, know the different categories of VAT supplies, and be able to calculate VAT, whether we give you an amount inclusive of VAT or exclusive of VAT.